Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Phil Mackintosh, Chief Economist at Nasdaq, to discuss macro trends that dominated 2021 and what to watch for 2022. And Phil, it seems a little bit obvious, but there are very specific areas of the market that 2021 was driven by.
Yeah, it's hard to say it wasn't driven by COVID, but really, when you look at a lot of the trading and a lot of the economics, it was driven by the stimulus that was a response to COVID. So we saw huge amounts of retail trading, which was net buying, which we've talked about before. A lot of that looks like it was because people had excess savings because of the COVID stimulus. But also on the economic side, we've seen the stimulus lead to a huge recovery in the manufacturing sector. People are buying goods or stuff, and that's led to the bottlenecks that we've seen at ports as people are trying to import more products, which has caused a lot of the cost to go up for companies, which in the end has led to inflation. So the stimulus, I guess, is really one of the big factors that we'll be talking about from a driver of 2021.
And how have companies weathered 2021 and ingesting those higher costs?
Yeah, really interesting, because for a long time, all I was hearing and all we were seeing was that costs were going up. So originally import costs were going up, transport costs were going up, and then all of a sudden you see wages going up. And when we got to the end of the year, you thought that some of the earnings reports might have actually started to show margins squeezing a little bit. But actually, earnings has been really strong. Margins have been increasing. And that's a lot of the reason why the market this year is up as much as it is.
And comparing options and equities markets in 2021 tells an interesting story. Tell us about that.
It sure does. So what you might not have realized is that a lot of the volatility that you can calculate out of option prices shows what the market expects risk to be like in the next 30 days. And that's actually been relatively high all year. It's been mostly above 20, which is a pretty big number in sort of historical perspective. But when you actually look at the market volatility, what ended up happening on returns on a day-to-day basis, we had kind of a boring year. We were pretty close to like, a typically boring low volatility year. So the difference or the premium between the option implied and the market realized is a record level for the last 10 or so years.
That is interesting. I would not have expected that, especially if you're thinking about the month of December where we have experienced some volatility. Do you expect this volatility to carry through for 2022?
Yeah, I think it's hard for it not to, really. There are just so many unexpected risks still out there. Obviously, Omicron, as you said, like December's turned into a pretty volatile month just because of Omicron. And so COVID's still out there. But on top of the risks of COVID, we've got some geopolitical risks starting to brew, whether that's in the South Pacific or on the sort of Eastern European front. And that could obviously upset markets if something happened in a military way. But I guess more important is what's going to happen with interest rates and inflation as all the stimulus runs out of the economy. And so the Fed has suddenly pivoted, as we've been talking about recently, from saying that rates will be low forever to really rapidly, aggressively talking about rates rising to tackle the inflation problems. And if they go too aggressively, we could have a recession. If they go too slowly, then maybe we could actually have some runaway inflation. And so it's a fine balance that the Fed's going to have to travel through the next year. And I think that ultimately there'll be somewhere where we think they've made a mistake, and the markets will probably react with a lot of trading and volatility at that time.
So do you think the Fed gets inflation under control and follows through with the expected 3 rate hikes?
Yeah, the expectations at the moment are there is still some, I don't want to say transitory, but some impacts in inflation that will be relatively short term. There's some evidence that some of the demand for product is starting to slow, that some of the accumulated savings is starting to run out. And so already the supply chain is starting to free up. And that should reduce some of the, price pressures from an input price perspective. If that happens, then inflation doesn't get out of control. Wage pressures might also moderate. If we can get COVID under control, you might get more workers into the economy as well. And so that will help push down wages too. So it's possible that inflation ends up, what the expectation is, it falls back from 6+% to about 3% over the year, which is much more manageable than 6 going on 9.
And Phil, to wrap up here, and this kind of sounds like a silly question with that laundry list we just went through, but what else could happen? What else are you watching for 2022?
Yeah, I mean, that's plenty, really. I'm going to be interested to see what happens with trading, because we've had huge volumes this year. Options markets have grown. Stock markets have seen record levels of liquidity. That's all good for investors. We've seen a lot of new investors coming into the market. And personally, I hope that what we do end up is with a relatively soft landing where companies can maintain their margins without inflation getting out of control. And we do actually have, it might not be a strong return next year, but a relatively stable market with good returns for investors to persist.
Oh, and by the way, we have midterm elections as well. There's a lot going on. All right, Phil, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.